Welcome, Jiri Krol from AIMA from London. Thank you that you are here. Made all this travel to Frankfurt from London. Thank you very much for that.
Thankfully, I wasn't that far, but glad to be here.
Wonderful. So AIMA is for alternative investment, right?
Yes.
And is an association, as we have in Germany as well. So on a perspective, alternative investments, we heard this morning it's quite intense for get some licenses in Germany to invest in alternative investments. Is it so much easier coming from UK perspective to invest in alternatives?
It's sometimes easier to run the business in the UK, as we heard, than it is in Germany. Often the reasons are not regulatory, but tax related. But overall, the framework is the same. We have a global pan-European framework that still stays similar to what it was even after Brexit in the UK. So, we see alternative investments thriving and the management of that thriving all across the EU now, thanks to that common framework.
And now that we all know that the crisis in Ukraine started quite recently, so over a year now, and has a big impact on the whole Europe. Do you feel and do you see the influence on your business? That a lot of question of alternative investments and renewable energy are coming?
Partially, yes. You see a realignment in terms of how people view the world, and that has an influence on how the strategies are run. I think the war in Ukraine underlined the need for an energy transition and more infrastructure investment. So we see continued flow of investments into private markets strategies, whether it's equity, real estate, infrastructure, or we're focusing on a lot is private debt. And so the war has accelerated some of the trends that were there already and is likely to deepen those trends. I think it's also slightly refocused some of the discussion around ESG and what types of strategies are kind of ESG eligible and non-eligible, or which types of investments might or might not be useful, especially around the defense sector, right? As oftentimes it's been seen as one of the sectors that isn't necessarily compatible for some people with the whole ESG ethos, and now we see how important defense is for the survival of democracies and survival of the values that we all share. So definitely an impact there, and definitely something that people continue to think about.
Thank you very much. And the question about investors, do you see that foreign investors means non-European, non-British investors are focusing more or less on alternative investments since 2 years now?
There is growth in interest in relation to alternatives. It started before COVID in a number of areas, primarily because of the low yields that public debt instruments in particular, so government debt or corporate debt, offered, right? Investors need to meet certain nominal growth targets for their investments and return targets. And so given that this traditional part, of your 60-40, let's say simplified approach to investing, the 40% that was normally in publicly traded debt was giving you zero, they had to look elsewhere, right? So this is one of the reasons why the growth of private debt was so significant prior to COVID. And again, what happened with COVID, it accelerated things because it introduced, volatility back to the market. And again, the simple approach on the equity side of things of buy and hold and, wake up in 10 years and things are going to be wonderful isn't working anymore. So people are looking for, on the liquid side of things, hedge strategies, other alternatives that maybe commodity strategies are back in vogue. So multiple reasons why there is an increase in alternative investment strategies, both on the liquid side as well as the private markets or illiquid side. And also governments in the United States, in Europe as well, are starting to try to support greater investment by asset managers into things like infrastructure and renewables. So there's also a policy push on the supply side of things when it comes to, for example, in the US, the Inflation Reduction Act your traditional UCITS or 40 Act funds are not going to be able to fund all of those very complicated investments required for the transition, but it is the prime domain of alternatives. So again, lots of interest, lots of growth. Started already, a decade ago, fueled primarily by the desire to obtain higher returns, but now there are more factors being added to it, and so we expect that the growth will continue at pace globally.
Last question, perhaps on this side, because especially you mentioned you are debt focused. So we saw from 0 interest rates on state government bonds and all this stuff, a rising interest rate now. Inflation is coming, not ending. We say in Germany the second quarter of recession has already passed, so we're on the third one.
Yeah.
And interest rates will rise. Is the interest of debt now less than before, or is it still there because there's not enough opportunity to invest?
It is still there. And the reason is that the returns are even more attractive, if you will, because private debt is offering primarily a floating rate of return. So one, you have this natural hedge against the rise of interest rates, and that's what investors saw in the last couple of years, that your fixed income portfolio may have plummeted, even safe government bonds went down 30% when it comes to long dated debt, and your private debt portfolio performed very well, and in fact started to perform better because rates were being reset every quarter as interest rates were rising, and so your interest income was increasing as the rest of your portfolio was plunging in value, and your income was not increasing at all because it's fixed, right? So the experience of investors throughout that period with private debt reinforced the value of that in your portfolios. And then two, as more economic stress comes, what happens is traditional lenders withdraw from the market. And so what happens, the private debt, with its dry powder, with available capital, can now access better opportunities at lower risk and at higher returns than what was the case 5 years ago. So if, for example, in the US, you look at the interest you get on unlevered debt, it's somewhere in the region of 11-12%. Unlevered debt, if you put a little bit of leverage on it, you're getting into the mid-teens, and that's an incredibly attractive return for an instrument that's senior in the capital structure, right? And in Europe, the numbers are slightly lower because the base rate's lower, but it's somewhere around 10%. And again, the comparison is one with the adjacent public markets, but also with the equity markets, the private equity markets. And in relative terms, again, private debt, it looks extremely attractive. And the vintages that are going to be originated this year and next are likely to be amongst the best vintages ever for the asset class.
Thank you very much, Jiri.
Thank you.